Hi guys, and welcome to another video for tutoring. Today we are going over provisions and options. So provisions and options is quite a large chapter. What we want to do is think of these like terms. So I'm going to get to it right away. This is quite a large chapter to go through, but make sure that we are just listing what it is. So like entire contract equals this, like what does it mean, what's in it, because that's all we're mostly going to need for this test. Okay, so I'm going to go ahead and share my screen. Perfect. Alrighty, so we're going to start out with provisions. Provisions are built into policy. They are rights that are built into the policy. Okay, provisions are different than options. Options usually have to do with money, and we are going to have to choose something, right? There's options to choose from. So we have provisions, which are rights that are built into the policy, and then options, which are choices that we need to make. So we're going to be going through all of this stuff. And what I want you to do is kind of think of them like terms. Okay, you're going to go top to bottom, and we're going to go through and just explain what each of these provisions means in this policy. Okay, so the first one is going to be entire contract. Entire contract is built up of everything that has to do with this contract. So, an entire contract provision stipulates that the policy, with a copy of the application, any riders, and any amendments are put all together. Okay, that's what makes up the entire contract. Entire contract equals policy application, along with any riders and amendments and the policy itself. Okay, so all of that stuff is put together. Think of it as like a folder that holds all of the information that has to do with this insurance. So riders are additions to your policies. They're things that we're going to add on to give us added benefits. And amendments are going to be changes on this policy. Okay, so that's what the entire contract is. Next is going to be the insuring clause. So the insuring clause is a clause in the policy that basically states that the insurance company promises to pay if a loss occurs, if that specified loss occurs. Okay. Basically, it's the promissory statement. Okay. If they don't abide by what they said in this statement, obviously there's grounds for suing them or doing whatever because of this insuring clause. So the insuring clause is the insuring agreement. It's the promise to pay in the event of a loss. It'll have it kind of like right on that front page of your policy, and it's going to state who is involved in this policy and in what way would this policy be paid out. So for like life insurance, it would say, obviously it would say death. So the insuring clause is just a specific little clause that says we promise to pay out said amount if a loss occurs. Okay. Next, we have consideration. Consideration, we've talked about a few times now. It is something of value that each party in this contract give one another in order to make this contract binding, right? To make the policy binding. Both parties to a contract must provide something of value or consideration in order for this contract to be valid. The consideration provision states that the consideration, right, value offered by the insured is the premium and statements made on an application. The consideration given on the part of the company is the promise to pay if a loss occurs. Now we have ownership. Okay, we're going to talk a little bit about ownership. So the policy owner, whether it's the insured person or not, whoever the owner is, has all of the rights. Okay, they make all of the decisions, and they are the only ones who can make any changes to this policy whatsoever. This also comes into play when someone wants to transfer rights. Okay, so here are some of the rights that a policy owner has, right? So the policy owner, they are able to transfer or assign rights from their policy. They're able to select or change premium payment modes, meaning how often or how much these premiums are paid. They're able to select or change beneficiaries, right? They can say, hey, nah, like if it's a revocable beneficiary, they'll just revoke them. They'll say, hey, we don't want you on there anymore, right? So they have the right to do that. They are able to convert the policy if they want to. Any cash values, they have full control on that, full control of dividends and surrender charges and periods. Okay, just basically, if there's any kinds of decisions that need to get made, the policy owner is going to be the one to make them. Okay. Now, when it comes to assignment means to transfer, to give. Think of homework, how a teacher assigns homework, they give it to you to do. Assignment is the transfer of these policy rights. So we're taking these policy rights and we're giving it to someone else, okay? And this can be either total rights, meaning all of the rights, or it could even be partial and temporary rights, right? So there's two different types. The assignment provision specifies that the owner's right to assign or transfer these rights of ownership in the policy owner must advise the insurer, though, ahead of time, right? In writing, okay? So they can't just say, hey, my policy, I'm going to transfer the rights to you and not tell anybody. We need to tell the insurance company, but there's a big difference between notifying them and asking permission. So we do not need the insurance company's permission to transfer these policy rights, but we do need to notify them just so that they can make sure to have that noted. The insurance company just wants to make sure that they pay the right people and that everything is updated on the account. Okay. So with absolute assignment, it's exactly what it sounds like. Absolute is going to be total. It's going to be total and permanent transfer of all of the policy rights. Okay, this involves transferring all of the ownership rights to another person or an entity. Okay, now the new policy owner does not need to have insurable interest in the insured. Remember that insurable interest is only necessary at the time of policy application, right? It only has to be there in the beginning. It does not need to continue to be there after. Next type of assignment is collateral assignment. Now, what I want you to think of is like a car, right? I don't know if you guys have ever taken like payday loans, but you give your car's title as collateral, right? Just for them to hold on to until you pay off whatever you borrowed. Right? So it's the same kind of thinking. Collateral assignment involves the transfer of partial rights, only some of them. They just hang on to a piece of it, okay, to another person. It usually is done in order to secure a loan or some other transaction. A collateral assignment is partial and temporary, okay, meaning it is going to be given back once this loan is paid, okay? Once the debt or loan is repaid, the assigned rights are returned to the policy owner. Okay, so that's assignment. There we go. All right. So with ownership as well, like I said, the owner is allowed to select and change premium modes. Modes is how often we are paying this premium, okay? The premium amount might not change for like a level policy, but the modes may change. There are 4 different ways that we can pay our policy. Okay. So this policy owner has the right to change this frequency however often they'd like to. And these are the 4 ways or modes that we can pay our premiums. So the first is annually. This is the cheapest way to pay our premium. Even though it's the most amount of money, it's only one time. So we save money on the monthly surcharges and transactions. So annually is the least expensive way to pay our premiums. Monthly is the most expensive way because every month we're making a payment and there's a surcharge with all of it. Okay. So annually is once a year, semi-annually twice a year, quarterly 4 times a year, and monthly 12 times a year. Those are our options for how often we can pay our premiums. Okay. So if the owner feels like it, they are welcome to change that mode at any point in time. Okay. Next would be selecting and changing beneficiaries. Okay, this is another right. It's a provision that the owner has. The policy owner typically has the right to change beneficiaries at will, meaning whenever they want. I always make the joke, like my husband's my beneficiary on my life insurance policy. Been with him for some odd 15 years now. But I tell him, I go, hey, if you breathe wrong next to me, I will change that beneficiary so quick. I will just change it. I will switch you right out. So don't play with me, right? So that's how we want to think about the beneficiaries. There are 2 types of beneficiaries, though. There are revocable. Revoke means to pull them out, right? If you revoke someone's license, you take it away. Revocable beneficiaries can be changed at any point in time as often as you want to. Okay, revocable. The second type is an irrevocable beneficiary. This just means the opposite. It means you cannot pull them out at will. You can't. You need to get that beneficiary's permission in writing, stating that they no longer want to be the beneficiary, that you would like to change them, and they are okay with that. Irrevocable beneficiaries hold partial rights over the policy. No, they're not able to really instill any power or anything like that on the policy. But if you want to pull out like a policy loan, right, you need to ask permission from this policy beneficiary because it's their payout too, kind of thing. That's how I think of it, right? So an irrevocable beneficiary cannot be moved at will. They need to, in writing, change the beneficiary information. And just to let you guys know, people are not really willing to do that, like ever. So when you do get licensed, make sure that you always put revocable. You do not leave them irrevocable. Okay. I did that once when I was brand new and it was a whole hot mess. It's a story for another day. But this ex-husband did not want to give up his beneficiary role at all. And the wife was not happy, right? So don't make that mistake. Always keep them as revocable, meaning this person can change their mind at any point in time. Okay. All right. Like I said, the owner is able to select settlement options, meaning how they want to be paid. Okay, we're going to be going over settlement options in a little bit, but just know that the owner has the right to make that decision, okay? Conversion, the owner has the right to make that decision as well. If they want to convert from term to whole life, they can do that, right? They have conversion privileges. Cash values and dividends. The policy owner has the right to surrender any policy for its current cash value at the time when the coverage is no longer needed or necessary or affordable. Okay. Once this option is selected, the insurer is no longer covered. Okay, so once you decide to forfeit your policy, you will no longer have any coverage from that point on. Okay. Anything that has to do with dividends, choosing how you would like to be paid. We're going to be talking about that in options, so I'm not going to get too far into it now, but just know that the policy owner has the right to make the decision on how they would like their dividends to be used in certain types of policies. Okay. All right. Next provision. Now we're moving on from ownership. Okay. So next provision is the free look period. Okay. The right to return and right to examine. So we know this as the free look period. This provision allows the policy owner 10 days. This one we need to know. It will be on your test. The provision allows the policy owner 10 days from the receipt of delivery to look over this policy, and if this person is dissatisfied for any reason, return that policy for a full refund of premium. Okay. The free look period starts when the policy owner receives this policy. Okay. It starts at policy delivery. Not when the insurer issues the policy, it's when it's actually delivered. So let's just say the the agent delivering took forever and did not deliver it until a week and a half after issue date. Then this person has 10 days from that delivery date to look it over. If they don't agree with it, then they can go ahead and they can cancel this policy for a full refund of premium. Okay, the free look period, 10 days. Next is payment of premium. The policy stipulates that when premiums are due, right, and however often they're supposed to be paid and to whom, it's all going to say it there. So if the insured dies during a period of time for which the premium has been paid, the insurer must refund the unearned premium. So basically, if you pay the premium for the month and you die halfway through the month, they're going to post I don't know what that's called. It's like they're going to backdate it. Okay, they're going to give you whatever was unused premium as well. So it's going to just come back in the form of payment. Okay. Grace period. Okay. The grace period is the period of time after a policy's premium is due that the policy owner has to pay this premium before the policy lapses. Think of like a grace period. Duh. That's what the word is. So think of like, I don't know, like your phone bill, right? And you have so ever many days to pay before it gets shut off. It's that. Okay. So the grace period, check with your state. If you're not in California, double check your grace period before you go and take your test. Okay. But here in California, and in most states that I've seen, each individual and group life insurance policy must contain a provision of for a grace period of at least 60 days. Okay, it is normally 60 days in order after this premium date is due before the whole policy lapses. Okay, so you have 2 months, right? 30, 60, yes, 60 days to catch up on those payments before your policy will lapse. Okay, that is the grace period, the period of time, that cushion, that period of time that you can make a late payment on your policy without it lapsing. Okay. Reinstatement. Okay. Reinstatement provision allows a lapsed policy, not a canceled policy. Write that down. Not a canceled policy. It has to be lapsed to be put back in force, right? The maximum time limit for this reinstatement is usually 3 years. So let's just say I have a policy and I get laid off and I can't afford it, right? So I stop paying it. and it lapses. And then a year later, I get a hold of an agent and I said, hey, I would like to re-up my insurance policy. I'm able to reinstate my previous policy as long as it's been within the 3 years. Okay. Usually, if we are reinstating this policy, the insurance company is totally fine with it, but they want to see evidence of insurability, meaning they will most likely have us do blood work and a physical just to double check that we are still eligible for this insurance, that we didn't get diagnosed with cancer and that's why we want to reinstate it. Anything like that, that we haven't had any issues with our health, anything. So we are able to reinstate that policy, but the insurance company might require evidence of insurability. Okay. So the advantage to reinstating a lapsed policy as opposed to purchasing a new one is that the policy will be restored to its original status. Okay. And retain all of the values that were established with the insured's issued age. So let's just say, like I said, let's just say 2 years goes by and I want to reinstate this policy. It's good to do that because my premium that I'll be paying is based off of that original year. It's not 2 years older. They're not going to re-quote me on my premium. So because insurance gets more and more expensive every year, we would want to make sure that we reinstate the old policy before starting a brand new policy. Okay. Perfect. And then, like I said, if a policy was canceled or surrendered, it is not able to be reinstated. All right. Incontestability. This is called the period of incontestability, okay? The incontestability clause prevents an insurer from denying a claim due to statements on the application after the policy has been in force for 2 years. Easily put, okay? Let's just say we apply for insurance, right? We fill out our application and we say that we are not a smoker, right? But we smoke occasionally, but we say we're not a smoker, okay? And they do their background, they do our physical, they look into our doctor's sheets, they don't see anything about it, so they don't catch it, right? And 3 years later, we die of lung cancer due to smoking, right? Our insurance company cannot go back and say, well, you said you didn't smoke on your application, because it's past that 2 years. The insurance company has 2 years to do their digging, to come up with their answers, to ask us any questions that they want to ask us. Past that 2 years, they cannot deny a claim, even if there was a misstatement or concealment. Okay. So incontestability is 2 years. Okay. After those 2 years, if we die in some manner that shows that, we were dishonest on our application, too bad, so sad. You guys should have caught it a little bit better. So that's what incontestability is. Now, the incontestability period does not apply in the event of non-payment of premiums. It also does not apply to statements relating to age and gender, right? Sex. Okay. What this means is, for instance, I had a client who we replaced her policy and they had her as a man. And she's not a man. She was beautiful, gorgeous, obviously a woman's name, everything. They had her as a man. Men pay higher premiums typically. So when we canceled this policy, they had to refund her all of that. All of the extra bit I think she got like $3,000 or $4,000 back, just from the little bit of premium increase that should not have been there. Okay. Same thing goes. So if they find out that, we're a man and not a woman, they're either going to adjust the premiums or adjust the death benefit at that point. Okay. So if it has to do with sex or age, they will simply make that adjustment. Okay. And then that's exactly what I'm talking about there. The misstatement of age and sex, same thing. They're just going to make the adjustment. So the insurance company on their end is not necessarily going to kick back that policy, but what they will do is adjust the death benefit so that it is in line with what it would have been. Okay. All right. Now, in life insurance, there are exclusions that are built into every policy. Okay. Our company has some benefits to it that other companies do not. But what I'm going to do is just go over the exclusions. You'll learn about those later. When you are licensed, your upline will tell you all about our great benefits, how we were one of the only companies to pay out during 9/11, how just all kinds of stuff. We're awesome. Okay. But for the meantime, I'm going to teach you the general exclusions that are in a life insurance policy for your exam. So exclusion number one, or first off, exclusions. Exclusions are types of risks, right? They're things that the policy will not cover. Okay. Certain exclusions are standard for all policies, while others are attached to a policy as an exclusion rider. Okay. The most common exclusions found in life insurance policies are aviation, hazardous occupation, war and military service. So I'm going to go over what these are. The first one is aviation. Most life insurance companies will cover an insured person who is a fare paying passenger, meaning we went like on vacation, we got on the plane, we paid our ticket, and we died in a plane crash. They will pay for that. However, they may not cover a pilot, right, that works for like a regularly scheduled airline. Okay. But they will exclude coverage from non-commercial pilots. So if you're like I don't know, like a for fun pilot, what's that called? A private pilot, right? You own an airplane and you have like a private license and you can just go and fly your airplane. That is where that exclusion comes in. Okay. It usually does not have to do with someone who is a paying customer of an airline, and it doesn't have to do with commercial pilots, even though they would probably have restrictions. This is talking about private pilots that like, oh, I fly for fun kind of people. Okay. Next is hazardous occupations. If the insured person is engaged in a hazardous occupation or participates in hazardous hobbies, such as skydiving, auto racing, bungee jumping, what's that thing that you go in the ocean? Scuba diving. Okay, those kinds of things. They will exclude death that results from this hazardous occupation or hobby. This may be excluded from the coverage, okay? If excluded, premiums paid will be refunded, but the death benefit will not be paid out if it falls within those exclusions, okay? The underwriter also has the option of charging a higher premium for insuring people who do these things, okay? So funny story, I had a client who worked on the oil rigs in the middle of the ocean. I don't know if you guys have seen like the Mark Wahlberg movie where the oil rig like blows up and it's like spilling over in the Gulf of Mexico. Okay, he did that kind of stuff. And he actually was not able to get coverage because of his specific occupation, because it's very hazardous. Which I thought was so strange because I would think like being a police officer would be more hazardous, but apparently He was denied coverage because of that, and I thought that was crazy, but that's where that comes in. Okay, so people with hazardous occupations or hobbies, that's why we ask those questions. Are you planning on going skydiving, bungee jumping in the next year to 2 years? Different kinds of preliminary questions when we're doing the application. Next exclusion is war or military service, okay? Most life insurance policies issued today do not exclude military service. However, there are actually two different types of exclusions that may be used to limit the death benefit if the insured dies as a result of war. Okay, so they've changed this recently. Before, it simply said no war, like at all. They would cut it all out. But now they're giving you options. So with the war clause, basically, if the president or if anybody declares an act of war, okay, or an act of terror, it gives the insurance company a window out to say, hey, we can't afford all of those death benefits, okay? Perfect example is 9/11. With 9/11, because I believe it was Bush at the time, he said, this is an act of war and terror. It actually gave all of the insurance companies a way out. And so there were very few companies that actually paid their clients out. Luckily, we were one of those companies that paid every one of our clients out. And our company actually remembers them every year and does a memoriam for them, which is awesome. But that would be an example of an act of war or terror. Okay. All right. Also, this falls under it. If you die while committing an illegal act, right, or engaged in an illegal occupation, it also will not pay out. Okay, so let's just say I'm a drug dealer, right, and I'm doing a deal, and the person who I'm supposed to sell to kills me. If they are able to prove that that's what happened, the policy will not pay out because I was killed in the process of doing something illegal. Okay, so that's that one. And then last one is suicide. So the suicide clause falls under that incontestability clause as well. So it's for the first 2 years of the policy. The suicide provision in life insurance policy protects the insurers from individuals who purchase life insurance with the intention of committing suicide, right? Sometimes people do crazy things to get their family money, unfortunately. So this protects the insurance company. If the insured dies by suicide within 2 years following the policy's effective date or the issue date, the insurer's liability is limited to refunding the premium. All they do is refund the premium and they say, hey, I'm so sorry, but that was against our provisions, right? So if the insured dies by suicide, though, after this 2-year period, right, the policy will pay the death benefit to the designated beneficiary, the same as if they would have died in any other way. My thinking is that prior to the 2 years, the insurance company is afraid that maybe this person was planning it or doing it on purpose. After the 2 years, this is obviously an issue with some kind of mental illness or some kind of mental struggle. And so it's seen a little bit differently. So after the 2 years, it will pay out. Before the 2 years, it will not pay out. Okay. Use this end part for studying right here. Okay, it gives you all of the provisions right there for you. All right. Beneficiaries. So beneficiaries, now we're getting into options. So beneficiaries, we have designation options. The beneficiary is the person or interest, I guess. I don't know what that really would be, but the person to which the policy proceeds will be paid upon the death of the insured. Okay. The beneficiary may be a person, right? It may be a human being. It can be a group of people, a class of people, right? It can be an estate. It could be an institution if someone wanted to beseech, no, bequest, bequest it, right? So it can be a lot of different things: foundation, charity, corporation, trustee, trust. With life insurance, this beneficiary can be whomever. Okay. So keep that in mind. In life insurance, the beneficiary can be whomever, whatever. Okay. I actually had a client want to leave her beneficiary as her dogs. And I talked her out of it. I was like, who's going to take care of the dogs? So, yeah. So that one's a wide, you can have a lot of choices there. Okay. The beneficiary does not have to have insurable interest in this insured person. It can be whoever the insured person wants it to be. In addition, the policy owner does not have to name a beneficiary either in order for it to be valid. So they can say all of my children, right? They can say my family equally. They can say all kinds of stuff. It can be worded however. You just want to make sure that how we word it is correct. Okay. Benefits that are designated to a minor. Okay, we want to do our best as agents not to leave a minor as a beneficiary, only because if this happens, the minor, if it's designated to a minor, they will either be paid to this minor's guardian, right? Or it will be placed in a trust with a trustee, okay, to this minor. If a trust is named the beneficiary or paid as directed by a court, the guardian and trustee can be the same person, but it's generally accepted not to be a good practice to have life insurance payable to a minor. Trusts are very expensive to keep up. It involves lawyers when it's a minor, and that'll just eat away at the money. So, for the most part, we want to find out who would take care of these children. And then at some point or another, once that child becomes of age, then you can change the beneficiary information once they are of age to receive this money. Okay. We have classes of beneficiaries. So a class is going to be a group of beneficiaries. So, for example, my children, right? That's a class. The children of John and Mary, right? We want to make sure like any wetlock children maybe didn't get the money, if you want to be like that, those are going to be classes. Okay. So there are two types of classes. When naming beneficiaries, it is very important to be specific by naming each individual, by designating the exact amount given to that individual as well. Two class designations are available for use when the insured chooses to name a group. The first one is called per capita, right? And I want you to think of captain, capita up here. Captains go like this. And then per stirpes or stripes. Okay, I call it stripes. But stirpes, think of a long line, one stripe. Okay, and that'll make sense in a second. Per capita means by the head. Okay, this evenly distributes benefits among the living named beneficiaries. Okay, and I'm going to give you an example in a second. Per stirpes or stripes, this is going to pay down the bloodline. Okay, so even if one of these beneficiaries was not alive, right, it'll pay their children. So here's my example, and I don't like to use myself as an example, but we're going to do it because I have a bunch of kids. So myself and my husband, right, we name our 4 kids as beneficiaries, right? Let's just say we're old. We're super old. And it says the children of Carly and Jonathan Samaniego, right? I have all of my children, like all four of them, right? They're older, they're grown up, they have kids underneath them, all of them, okay? Let's just say that when I pass away, one is not, I don't like this. One is not there to collect the benefit, right? Per capita is only going to pay per the head. So 1, 2, 3 children that are available for this death benefit. It'll split it evenly between them. Per stirpes, even though one is not here and available, they will still pay 1, 2, 3, 4, but instead of paying this person who's not here anymore, they're going to pay his bloodline, so his wife, his children. So his portion will not get split up between the others. His portion will go to his bloodline. Okay? So hopefully that makes sense. Per capita, think like this, by the head. That person has to be there, like boom, boom, boom. Per stirpes, it'll pay down the bloodline. So if this person is no longer here, it will pay its children. Okay? Succession. Okay, we already talked about succession. Succession, right, just like royalty, is going to basically state who is in line, who is in order to receive these policy benefits. We have the primary beneficiary, right, the first in line, and then we have a contingent beneficiary. This is also called a secondary or a tertiary beneficiary. Tertiary beneficiary. This has second claim to the money if in some event this primary beneficiary dies before the insured person. Okay, contingent beneficiaries do not receive anything if the primary beneficiary is still alive at the time of the insured's death. Okay. We went over revocable and irrevocable. Please know those for your test. Revocable beneficiaries means that we can revoke them or take them out at any point in time. Irrevocable means that we cannot just do that. We need written permission from them, letting the insurance company know that they would like to step down as the beneficiary. Okay. Common disaster clause. Okay. Common disaster clause. If the insured, let's let it load. Of course. Okay. Okay, common disaster clause. If the insured and the primary beneficiary die at approximately the same time from a common accident with no clear evidence that one died first, questions may arise in identifying which party is eligible for this death benefit. Okay. The common disaster clause basically states, it provides that if the insured and the primary beneficiary die in a common disaster, even if like one is in the hospital and barely hanging on and then passes away, it doesn't matter. It's going to automatically pass the primary and go straight to the contingent. The reason being is because if the primary beneficiary, right, is going to pass away, they want to make sure that money is meant to go to the right person. Okay, so it says the common disaster clause, when added to a policy, provides that if the insured and the primary beneficiary are in a common disaster, even if the beneficiary outlived the insured by a specific number of days, it is presumed that the primary beneficiary died first. This is so that the proceeds will be paid to either the contingent beneficiary or the insured's estate if no contingent is stated. Okay. Most insurers do specify a period of time of usually 14 to 30 days in which the primary beneficiary's death must occur in. That's not so important to know. It's just the act of the common disaster clause that we do need to know. Okay. As long as the beneficiary dies within this specified period of time following the death of the insured, it will be interpreted as if the beneficiary had died first. The intent is to fulfill the wishes of the policy owner in regard to payment of the proceeds for the beneficiary. Okay. Now, for example, James had a life insurance policy that included a common disaster clause. James was insured. His wife Maggie was named the primary beneficiary, and his son Ben was named the contingent. James and Maggie got in a terrible car accident, and James died immediately. But Maggie died 4 days later from her injuries in this same accident. Because the policy included a common disaster clause, the death benefit would be paid straight to Ben, okay, the contingent beneficiary, as if Maggie, the primary beneficiary, had died before James. Okay, so basically it's going to pass up the primary beneficiary just to protect that money. Then we have spendthrift. Okay, so spendthrift clauses, this is to protect the death benefit from the beneficiary's creditors coming after this money. Okay, so the spendthrift clause was included, and if it was included in a life insurance policy, this protects the beneficiaries from the claims of that person's, the deceased person's creditors, as well as prevents the beneficiary's reckless spending of the benefits, requiring that the benefits be paid in a fixed period or a fixed amount of installments. Okay. Think of like leaving the money to, I have a little brother, right? He's very good with money, but let's say he wasn't, and I'm leaving the money to him to take care of. He's younger than me. Like, I could see him blowing that money easily, right? Buying things, unnecessary things, not letting the money last like I wanted it to. The spendthrift clause can be built in a certain type of way that'll allow fixed periods or fixed amounts. That way he doesn't have all the money to burn in his pocket all at once. Okay, and they do this through an annuity. Okay. The beneficiary does not have the right to select a different settlement once a settlement has been chosen. Okay, just because that person passed away does not mean the beneficiary gets to go, well, I would like it this way instead. No. Okay, however, the insured person or the policy owner set that up is how it's going to be paid out. Okay. The spendthrift clause is designed to protect life insurance policy proceeds that have not yet been paid to a named beneficiary for claims of the creditors the beneficiary or the policy owner may have. Okay, so it just protects the money from people getting their hands on it before it goes to what it needs to go to. Okay. Okay. So we are going to stop here. I am going to go over non-forfeiture options, dividend options, and settlement options next. Options are going to be choices that we need to make when it comes to money on the policy. So this next part, it'll be a big section. And then right after that, we're going to go into riders. We're almost done with these videos, guys. There's only probably 3 more videos after this one. It's going to be annuities, riders, and then options, which is the second part to this. I hope you guys are all doing great, that you guys are all getting very close to scheduling your exam and finishing up all of your quizzes and hours. If you need anything or if you have any questions, please reach out to your upline. Please reach out to your RVP, and I hope you guys have an awesome time.